Okay, thanks for coming to this session. I'm the moderator of this session, which is G2 War and China's New Normal. I'm Professor Tae-Yun Sung at Yonsei University. We have a great panelist. So we will have this session. So to begin our session, each panelist will have 5 or 7 minute initial remark. After we have those remarks from each panelist, and then we will have the discussion time for this session. So first remarker is Zhiwu Chen. He will have some remark for this session. Please.
Thank you, Professor Sung. For my 5 to 7 minutes, I have a few slides to show you. The background for the first slide is this. Back in 2009, a magazine in China called China Entrepreneur asked me to write an article to assess what China will be, how China will be in the year 2049. My first response to them was that I have never made forecasts that far. Okay. So I said I should not write this, but nonetheless, they convinced me to write it. And then I wrote this article. Basically, in this article, I outlined my forecast for China's future from the point of 2009, so a year after the financial crisis of 2008. In this forecast, I laid out the following. First, from 2009 to 2019, over this 10-year period, China would still stick to the old familiar economic growth model that is heavily dependent on investment and heavily dependent on government interventions, government agencies managing everything all the way. And then the Chinese economy would peak in 2016, which is this year. And then there would be a major crisis in 2017. Then after 2019, for the next 30 years, China would really engage in political reforms for 30 years. So basically, I described a picture in which the first 30 years of the People's Republic of China was engaged in planned economy. Then the second 30 years in economic reforms, followed by 10 years of stagnation with a lot of talk of further reforms, but actually not doing really much in reality. Dragging it on and modeling through. And then in the end, some crisis would happen around 2017 or 2018, which would force the government and the party to really undertake more serious reforms to create a coherently, growth-oriented economy and so on. Of course, many of you may wonder, how accurate so far has my forecast been? I have to say, up to this point, it's pretty much like what I described in that article. So for the last 7 years or so. But at this point, I'm getting more nervous about my forecast regarding 2017. At that time, I have to say, I did not take into account the fact that in 2017, the 19th Party Congress would take place to put politics above everything else. So now I'm changing my forecast a little bit. So the crisis may likely occur not in 2017, more likely in 2018 or 2019. But then after that, maybe the reforms would take place. So some of you may wonder, why did I make this crazy forecast? The three basic assumptions I made were as follows. First, the government controlled and investment-driven growth model would continue, even though a lot of, as I mentioned earlier, there would be a lot of talks about reforms. Secondly, the SOE dominance in the Chinese economy would continue. So in fact, so far, of the last 3 years in particular, the SOE dominance not only has not weakened, but actually has gained much more momentum, more strength, and more emphasized by the party. And then one last piece of assumption is that the debt-driven growth would continue. So this is why today we are looking at 3 major bubbles that I touched upon this morning. The first bubble is the debt bubble, and the second one is the housing bubble, and then the third bubble is the renminbi exchange rate bubble. Some of you may wonder, numerically, if we want to hold my forecast to a good test, good standard. So back in 2009, I made the following assumptions. Okay, the Chinese economy would grow at about 8.5% until 2016, this year, which of course is off the mark. And then the US economy would grow at about 3% a year forever. So with a few other assumptions, my forecast for the GDP this year, 2016, was 9.4 trillion US dollars in nominal terms. But this year, very likely, the actual nominal GDP for China, based on all the official numbers, is likely 11.5 trillion. So I was off by about $2 trillion there. Based on PPP, the GDP would be this year, according to my forecast earlier, 16.3 trillion, but this year the actual PPP-based GDP is 21.2 trillion US dollars. The US forecast was a little bit off as well. My forecast was short by about 1 trillion US dollars. Okay, so what will happen next? As I mentioned, the 3 major bubbles, all of us are very interested in knowing which one of the 3 bubbles would go first. It's really tough to say, but if I would have to guess, based on all the internal incentive structures and how the political economic system is set up, first I want to emphasize that that bubble is probably unlikely to unravel first, mainly because, as I mentioned this morning, in China, you can, as a lender, you cannot force the borrowers to really pay you because the government can really can tell you just to stop going after the insolvent borrowers. So if that's the case, debt contracts, when they are not enforced really literally, then you would not have so much of a debt crisis to easily happen. So very likely the real estate bubble, or maybe the renminbi exchange rate bubble, may go first to really start this process of unwinding and correction of the excesses that have been seen and experienced and talked about in China and outside China. So let me stop here. Okay.
I'm going to begin by talking about the renminbi because I have just published a book on the renminbi, and it's a good place to start. When talking about China's currency, it turns out one can go back a long time because the renminbi has in fact been in existence only since 1949, when the People's Republic of China was formed. But the monetary history in China, some of which I go over in my book, dates back a long time. In fact, it turns out that China had the first paper currency in the world in the Song dynasty in the 7th century. China also had the first fiat paper currency in the world, not backed by commodities or precious metals. We know this from the writings of Marco Polo, who visited the court of Kublai Khan and was fascinated because at the time there was no paper currency in Europe. And he said this emperor just puts his imprint on mulberry bark, which is what paper was made of at the time, and everybody in his province accepts it as currency. He said this is true alchemy, to take mulberry bark and convert it into money. And how did Kublai Khan make it fiat currency? he basically passed a decree that anybody in his domain who did not accept the currency would be put to death. Turns out to have been very effective. China also had one of the first currency wars in the world. In the late 1930s, the Kuomintang government had set up its own central bank, and then the Japanese, who by then had occupied parts of Manchuria, set up their own central bank through a puppet government in Nanjing. And both these central banks started operating in Shanghai. So one day, the Kuomintang government went and bombed with dynamite the central bank branch of the Japanese government, and the Japanese government in turn dragged the employees of the Kuomintang-controlled banks out onto the streets and started executing them. So this was a real currency war. If you think these days you're seeing a currency war, certainly not like those currency wars when there was blood on the streets. Turning to more recent history, certainly the renminbi has come a very long way in a short period. After all, it was only about 5 to 7 years ago that the Chinese government started opening up the capital account, and since then it slowly started making the currency more flexible. It started putting in place some financial market reforms, and remarkably, the Chinese currency has made enormous progress as an international currency, as a currency that is used widely in trade and finance transactions. Right now, about 3% of global payment transactions intermediated through SWIFT are denominated and settled in RMB. It's not a very impressive number yet, but remember, it started from zero literally 3 years ago. If you look at China's progress as a reserve currency, there too the renminbi has actually begun to take hold. On October 1 of this year, the IMF officially included the RMB in the SDR basket, which until now had just the 4 elite currencies, the dollar, the euro, the yen, and the pound sterling. So it seems like the renminbi has ascended to that elite level. But is that really true? Certainly the IMF's seal of approval is very important. There are other indicators. No matter what the IMF says, about 1 to 2% of global foreign exchange reserves are already being held in renminbi-denominated assets. There are about 34 central banks around the world that have signed bilateral local currency swap arrangements with the People's Bank of China. So it seems like the currency is well on its way to becoming a reserve currency. But there is a problem. And that problem comes to the heart of what it means to be not just a reserve currency, but also a safe haven currency. Now, even in terms of a reserve currency, the renminbi does not have all the prerequisites of a reserve currency. China does not have a fully open capital account. China does not have a fully market-determined exchange rate for its currency. And China does not have well-developed financial markets. Ultimately, what will determine the RMB's significance as a reserve currency is whether foreign investors have good, high-quality renminbi-denominated financial instruments that they have easy access to and that they can easily trade in and out of. That's not quite happened yet, but it's moving in that direction. So some might say China does not meet the traditional prerequisites of a reserve currency, and already the renminbi is the reserve currency. So if China does do everything that is needed, open up its capital account, allow its currency's exchange rate to float freely, have better developed financial markets, then the renminbi will take over. I think not. There is a very important distinction to be made, which did not exist in the past, between a reserve currency and a safe haven currency. All the reserve currencies out there that one can see, other than renminbi, are safe haven currencies. But what do you need to be a safe haven currency? For that, you need not just economic size, not just good financial markets, but you also need the trust of foreign investors. And what do you need for trust? So I argue in my book that what is behind the trust of foreign investors is an open and transparent form of government with institutionalized checks and balances. You also need the rule of law, and you need trusted independent public institutions like a trusted central bank. President Xi Jinping's government has made it abundantly and explicitly clear that it is moving forward on financial market and economic reforms, but broader political, legal, and institutional reforms are off the table. So my anticipation is that if China plays its cards right with economic and financial market reforms, then the renminbi could become a significant reserve currency, but it is not going to become a safe haven currency and is not going to challenge in any way the dollar's supremacy. But even this notion that the renminbi could become a significant reserve currency suggests that things are going to go well in the Chinese economy. So what could go wrong? Professor Zhiwu Chen already laid out some issues of bubbles, and there are very serious risks building up in the Chinese system. My concern about China is not about short-term growth. I think in the next year to two, China has enough room in terms of monetary policy, fiscal policy, in order to generate that kind of growth. But the big question about China is always, how does China get to that growth, and what are the risks that are being built up in that process? Now, at some level, there is good news about China. Certainly, it looks like this growth rebalancing effort is taking place. You do have consumption playing a bigger role in driving growth in China rather than investment. The services sector now does account for more than 50% of GDP and a significant portion of GDP growth. Plus, you have employment being generated not just by the manufacturing sector but by other parts of the economy. And the saving rate, the household saving rate in China in particular, which had been rising for a long time and working against the notion of consumption-led growth, it has started declining in the last couple of years. So there is progress. But I think right now is a very risky time for China. Why is it risky? It's not because there are no reforms. In fact, over the last year and a half, there have been reforms, very important ones. China has completely liberalized its interest rate structure. Just last fall, they liberalized the interest rate on deposits. China has continued with capital account opening measures, both in inflows and outflows. There has been a move to make the currency more market determined by freeing up the exchange rate. An explicit bank deposit insurance system was put in place last year. But notice one thing. Every single reform that I can speak about has to do with the financial sector or the capital account. And therein, I think, lies a real risk for China, because two things are not happening in tandem. One is reform of the real side of the economy. As both of the previous panelists have also already alluded, it's going to be very difficult to move forward with financial market reform and indeed to have it work well if you don't have the real side of the economy, especially state enterprise reform, keeping pace with financial sector reform. There are a variety of other reforms to the labor market, to the fiscal taxes and expenditure systems that all need to be taken care of. It's not that the Chinese government doesn't know this, but there's been very little progress on that front. Another very worrying front is the fact that there are no institutional reforms taking place. What do I mean by this? Let's take the stock market volatility last year as an example. The government has often spoken about letting the markets working well, and they view the market as very important, as a resource allocation mechanism, as a price discovery mechanism. But in order for markets to work well, what do you need? In the stock market, you need better corporate governance standards, you need better auditing and accounting standards, you need better corporate and public transparency. On this institutional side, very little has been done. So I think we are reaching a very interesting point in the Chinese reform process where the reforms themselves are creating some risks, not because they are not good, but because there is just one aspect of the reform process that is moving forward. So it's getting very unbalanced. You have financial market reform, but you don't have real side reforms keeping pace, and you don't have institutional reforms keeping pace. So I suspect that China has created enough room for itself to manage some of these bubbles, but that process itself is going to be very risky. So I anticipate that Chinese growth is going to slow down. I think the economy is moving in the right direction, but because of this very unbalanced nature of the reform process, it's going to be a wild and interesting ride in the years to come. Thanks.
Thank you. Let me start my question for the Eswar. So you mentioned about the role of renminbi as a development in the status of international financial market. Okay, and then if the renminbi should, if the renminbi want to become a key currency, in the international financial market, we need renminbi denominated assets, trustable assets, especially. That means, in that sense, we might need some government bonds or something like that. In many cases, in international financial market, government bonds are working as a key, currency denominated assets. Then that means we might have some issues in government deficit in the U.S. Even before we get into what you just said, the public institutions or something like that, there might be an issue of the government bonds. So what about your opinion on that kind of suggestion then?
Certainly the availability of renminbi denominated assets, especially fixed income assets, is going to be very important. Both official investors like central banks and sovereign wealth funds and also private investors want high quality assets whose value they have a reasonable amount of trust in. And here again, there has been progress. If you think about China's overall bond market size, adding together the corporate and government bond market, that's about a $5 to $5.5 trillion market. So it's bigger than many other reserve currencies out there. The question is whether these are widely traded, whether those markets are liquid, and whether there is a good supporting infrastructure, including a good regulatory framework. The capital account openness is also a very important criterion, and here there has been progress. Just earlier this year, the Chinese government did undertake certain very important reforms. It did open up the corporate and government bond markets to foreign investors. The limits on the qualified foreign institutional investor or QFII scheme was lifted, so QFIIs can basically automatically get quotas up to $5 billion. Plus, the Chinese government has made it easier to repatriate investments. In fact, many of these moves were made because MSCI required China to take all of these steps in order to have the A shares considered for inclusion in the MSCI index. It turns out that in its June review, the MSCI did not include A shares. Why? Because even though China did tick off all the boxes that the MSCI had set for it, number one, it did not tick off all of the boxes, and second, as MSCI put it, its investors were not convinced that the Chinese government would follow through in practice what it had said it would do in principle, for instance, reducing the lockup periods. So this notion of credibility of the government that draws in foreign investors is very important. If you think about the SDR decision by the IMF, it was a very similar process. The IMF set out a checklist for China to meet, and China did tick off all the boxes. But there were questions about whether they meant it. So for instance, on August 11, 2015, China did move to a more market-determined exchange rate. But after that, that set off a wave of currency depreciation and capital outflow dynamics. So then the government, the PBOC, stepped back into the market to prevent the renminbi's value from falling too fast relative to the dollar. So I think this sort of policy instability and the sense that the government is not necessarily going to follow through on its commitments, I think, is very important in terms of keeping foreign investors out. So it's going to require better policies, including policies that promote financial market development and easier access to those markets. It's going to require improvements in the regulatory framework, and as I think many of the panelists have alluded, it is going to require more fundamental changes to the institutional framework. China's moving forward on many of the aspects related to financial sector liberalization and development, but not the institutional reforms. And that has to begin as well.
But as just the Eswar said, we need to focus on the financial market to have a sustainable economic growth in China. But let me ask the Zhiwu. I mean, Chinese people are saving a lot in the way of having some U.S. assets, because as we know, they had the current account surplus, and then that means central bank has acquired a lot of U.S. assets like the treasury bonds or something like that. Then what do you think by having an increase or growth in Chinese asset market, then China can overcome the kind of investment style in future?
It's very interesting to hear Eswar summarizing the financial reforms, especially in connection with the renminbi internationalization efforts. But if you actually look at the details, if you don't want to be misled, a lot of the capital account liberalization efforts have been only in one direction because of the last few years, especially after last June's, or after the stock market crash in June 2015 and so on, the government really would like more foreign investors to come in particular to help stem, help protect the foreign exchange reserves, and also in order to support the renminbi exchange rate. So they were very quick to open up the inflows of foreign capital through QFII and other programs. But at the same time, really tightening up the outflow restrictions. By today, they have been very successful to make citizens as well as corporations now more and more difficult for them to really move capital out. There used to be, well, there still is the $50,000 cap on each citizen, on how much each citizen can actually move money out of China. But today it's very hard to really use that $50,000 upper bound because they have this rule, but if you really want to do it, there are many ways to make life more complicated for you. So in the end, you want to give up trying because they ask you a lot of questions, ask you to fill out this form, that form, and come up with evidence to prove that you are doing some legitimate transfer out of China, not to to show your negative, pessimistic forecast about the future of the renminbi and so on. So the outbound capital account restrictions have become extremely tight over the last now a year and a half and so on. So Eswar is right that the institutional reforms have been very much lacking. If anything, there have been reversals of past institutional reforms. Without getting into the details because of time, let me just mention two big trends. Right, one is some of you may know, the 1980s was marked by Deng Xiaoping's efforts to separate the party organizations from the running of government functions. So the 1980s was focused on separating the party from the government functions. And the 1990s was marked by efforts to separate the government from business, enterprise, management, and so on. So, but of course, over the last 3 years or so, both types of reforms have been reversed. So now the party and the government no longer keep each other from messing the other side's business. And now the enterprises are no longer, especially the SOEs, are no longer free from administrative interventions. Of course, everyone among the top SOE managements all over China knows very well. The party is absolutely first. The party secretary is the real person in charge. Of course, now recently there are efforts by listed SOEs to change the charters, so to officially allow, in a corporate governance sense and legal sense, allow specific roles for the different party committees. But the point is, there are a lot of reversals. Of course, those reversals many times have been done under the name of reforms as well. So in the Chinese language now it's so confusing, which mention of reform really means reform, right? And which means the opposite of reforms. It's so confusing, but things are different. So I think if we want to look for evidence proving progress in institutional reforms. Unfortunately, you will find more pointing in the other direction rather than in the direction you would like to see. Yeah.
Thank you. So we are out of time. So let me wrap up our session, G2 War and New Normals. By having their remarks and our discussion, we know that there would be a new way of the Chinese economy, but we also know that there would be a lot of challenges that we should really care about. Then I hope you can get those ideas from this session. Thank you for this session, and please give a round of applause to all the participants. Thank you.
The World Knowledge Forum